Good afternoon, everyone. I appreciate you taking the time to attend this call. I'm Sid Rajeev, Head of Research at Fundamental Research, and our guest today is John Arbuthnot, CEO of Delta 9 Cannabis. D9 is a vertically integrated cannabis company serving in the recreational cannabis market in Canada. They have cannabis cultivation, retail stores, they offer B2B consulting, and manufacture grow pods to cannabis operators. We initiated coverage back in September 2020, and D9 is one of our top picks in the cannabis space. So the agenda for today is I will kick off the call with our thoughts on the recent merger announcement between Aphria and Tilray, and John will take over from there and introduce us to his company, highlight some upcoming catalysts and things we can watch out for. For listeners, you can either wait till the end to ask questions, or if you have questions during the presentation, feel free to type them in and we'll try to respond to them. We encourage questions to be directed to D9 since we have John on the call today. Here are some key disclaimers. Please take a moment. Okay, so let's get started. Last month, Aphria and Tilray announced plans to merge, creating the world's largest cannabis company. The deal is valued at $4.8 billion, and the combined entity will have $900 million in revenue. The deal reflects a multiple of 10 times revenue, which is a 60% premium to what we believe is a sector average of 6.3 times revenue. This is a clear indication that buyers are willing to pay more in this market for their ideal targets. Now let's look at the deal's rationale. Number one, we think merging with Tilray allows Aphria to expand its presence in the US and in Europe. Number two, Tilray's focus on hemp and especially cannabis 2.0 products, such as edibles and beverages, allows Aphria to both expand and diversify its product portfolio. And number three, and which is quite relevant, is this deal is expected to result in annual cost savings of $100 million due to cost synergies. Now, let's look at the Canadian cannabis sector and see which sectors are ripe for M&A this year. As shown here, 75% of the industry's revenue comes from cannabis flower and related products. There are over 500 producers in the country, and since cannabis is just another agricultural commodity, we believe there will be consolidation among producers to capture cost synergies. This chart also shows another key figure. Edibles and beverages currently account for under 10% of the Canadian cannabis market. In more mature markets such as California and Colorado, this segment accounts for 15 to 20% of the overall market. Therefore, we believe that edibles and beverages market is set for strong growth in Canada. Now let's look at cannabis retail sales in Canada. As shown in this chart, sales have shown steady growth despite the pandemic. We estimate that cannabis retail stores were up at least by 120% last year, 2020. A key reason for this is the increase in retail stores. Retail stores in the country were up 70% from February to December 2020. The current count is about 1,400 stores countrywide, and we believe there's room for at least 2,200 more stores in the country, and that's based on this table. We believe a significant portion of the new stores will be from Ontario and Quebec, and this is based on the high population to store ratios in these two provinces. As you can see here, Canada's average is 27,000, which is 27,000 people per store, while Ontario is at 46,000 and Quebec is at over 180,000. To conclude, in 2021, we expect three things. Number one, strong growth in retail stores and cannabis 2.0 products to result in stronger retail sales. Number two, consolidation in the space. And number three, further expansion into the US, especially considering the recent Democrats' win increases the probability of federal legalization in the US. Now, before I invite John, I want to show you a table with past acquisitions and their valuation multiples. The average deal size, as you can see here, was $750 million, and that's the deals done in the past few years. And the multiple was 50 times revenue. As mentioned earlier, we estimate that the sector average is just 6 times revenue, and Delta 9 is trading at under 2 times revenue. With that, I would like to welcome John, CEO of D9. John, you'll be able to share your screen now. Please go ahead when you're ready.
Yeah, absolutely. Guys, can you see me on the screen there now, Sid?
Yes, John, go ahead.
Perfect. So thank you, everyone, for joining us this afternoon, and thank you to Fundamental Research for allowing me the opportunity to be here to chat with investors today. Real goal today is to lead you through the very high-level details around Delta 9, why we feel there's a compelling value proposition to Delta 9's equity currently, and then answer any questions that investors may have. Before I begin, I know there was a legal disclaimer from Fundamental's side. I do just want to note that the presentation today may contain forward-looking statements, so more information on that is available in Delta 9's public filings, which are available on SEDAR. Full history of the company: Delta 9 is one of Canada's oldest cannabis companies. We now have over 7 years of operating experience. We became the 4th licensed commercial cultivator of medical cannabis way back in 2013 on the old Health Canada MMPR program. So quite experienced in terms of cannabis cultivation. In early years of the company, we're really focused around producing cannabis products on the medical side, providing those to medical patients across Canada through, again, the early years of that medical program. 2017, with an eye towards legalization, became the real growth year for the company. We raised about $10 million throughout the year. We listed our shares on the Toronto Venture Exchange in November 2017. Since that time, we've raised a little over $80 million through a mix of debt and equity to fund the expansion of our various businesses. We're now one of the few vertically integrated and diversified cannabis companies operating in the Canadian space. So first main business segment is the Health Canada licensed business, licensed for cultivation, processing, extraction, and wholesale distribution. I'll speak a little bit more on each of these segments in more detail. On the retail side of the business, we currently operate 9 Delta 9 branded retail stores across Western Canada, and building out our chain of Delta 9 branded stores throughout the Prairie provinces. And we operate our business-to-business segment, so sales of our proprietary cultivation platform, providing consulting and licensing services to other licensed and pre-licensed operators, and providing cannabis genetics. So really any of those picks and shovels side of the industry. Business has grown significantly over the past 3 years since the company has listed its shares publicly. We have now uplisted to the main board Toronto Stock Exchange, where we trade under the symbol DN. We also trade over the counter in the United States on the OTCQX under the symbol VRNDF in the United States. Now, on the cultivation side of the business, is how we grow, as opposed to the big open greenhouse model that many of our competitors undertake. We grow in small modular units that we call grow pods. Real ideology here is to put the cannabis cultivation side of the business into a relatively small unit where we have a high level of control over the growing environment. We dial in those factors that most directly contribute to product quality, leading to a higher quality output product. Also gives us the ability to customize the environment for each genetic strain of cannabis that we're growing, and helps mitigate crop loss and spread of contamination, disease, etc. So a number of benefits to this type of growing platform. Also a strong economic case for the pods. We've invested heavily in automation. As our facility has scaled over the last few years, our production cost per gram last quarter was just 74 cents per gram. So it puts us in an industry-leading field in terms of production cost. Obviously, that's very important in a very competitive cannabis wholesale environment. From a scale perspective, we have 297 of these small modular grow pods licensed by Health Canada. Gives us a cultivation capacity of about 8,300 kilos per year right now. So in the area of about $25 to $30 million per year in our cannabis production and wholesale business. We do manufacture a scope of products. So dried flower is obviously the focus. It's about 70% of the product portfolio, but we also manufacture pre-rolls, blended cannabis, ingestible cannabis oils, cannabis vapes, and cannabis concentrates. And we are expanding out that product line significantly over the coming year. really to participate in the vast majority of the different product verticals that Fundamental has mentioned in terms of the Canadian cannabis space. From a distribution standpoint, we are licensed for distribution across 6 Canadian provinces, so Manitoba, Saskatchewan, Alberta, British Columbia, Ontario, and Newfoundland. Gives us access or distribution reach to up to or upwards of 25 million potential Canadian consumers across those markets. And we are continuing to expand our distribution footprint toward our goal of being a national distributor of cannabis products. Vertical integration into retail plays a key role in terms of our company's business strategy. We very much like retail. Again, the company is currently operating 9 Delta 9 branded retail stores across Western Canada. And we plan to open up to 20 stores. So 11 additional stores, taking our total store count to 20 over this calendar year in 2021. Feel there's a number of benefits to retail. It gives us control over the direct to consumer sales force, essentially the bud tenders that are driving a lot of purchasing decisions. It allows us to brand and market ourselves in an environment where branding and marketing is very limited in the Canadian space. It allows us to capture additional revenue and margin, obviously, through our retail segment versus simply being a wholesaler. And there's a huge amount of value for Delta 9's manufacturing business in the data collection and analytics and being able to track consumer trends and marketing activities, et cetera. So huge number of benefits that come to us through our retail chain. Finally, our business-to-business segment, again, sales of our proprietary grow pods. I would say most notably in our B2B segment, this is a segment that we are allowed to push into the United States. So most cannabis companies are limited from participation in the United States. This business segment for us, the B2B segment, the non-cannabis touching activities, sales of grow pods, equipment, consulting, all activities that are legal for us to conduct in the United States. So we successfully built out facilities in Maine and Michigan over the last calendar year. We plan to continue to expand our business in the United States moving forward. It's also a business segment that has allowed us to diversify more along the lines of developing technologies to help the fight against COVID-19. We recently released that the company has developed a decontamination pod, which uses a combination of heat and UVC technology to potentially decontaminate materials that would be contaminated with COVID-19. So now conversations underway with governments, healthcare unions, et cetera, on commercializing that technology, and really gives us a way just to retool our manufacturing line to increase revenue through COVID-19. I'll finally just touch on the financials before we open up for some Q&A here. But on the financial side, you'll certainly see that the company's focus on operations has begun to pay off. Revenues for just the third quarter this year were $13.1 million, so up 97% year over year. Revenues for the 9-month period ending September this year were $37.9 million, again, up almost 100% from the previous year. Companies demonstrated a track record for revenue growth and significant revenue growth in every year since we've listed our shares public. In 2017, we had less than $1 million in revenue. That grew to $7.6 million in 2018, to over $32 million last year. And the company was on pace for well over $50 million in top line revenue as of the end of Q3 this year. Most notably, I think for a cannabis industry operator in the Canadian space, Delta 9 has begun to reach the inflection point to profitability. We've produced positive net income from operations in 3 out of our last 4 operating quarters. We produced over $1.9 million in adjusted EBITDA for the first 9 months of this year. So we will continue with that focus around producing financial results and with a focus, obviously, on positive EBITDA, profitability, and cash flow from operations. Company also has a strong balance sheet. We ended the third quarter with over $7 million in cash, over $25 million in working capital. The company also recently completed an oversubscribed and upsized $5.7 million equity unit offering to ensure that we continue to have a balance sheet that is flexible and allowing us to capitalize on opportunities for consolidation, for M&A, where assets become available, they can expedite our expansion and provide strategic value, improve our financial and operating performance. That will certainly be a key focus for the company, as we certainly agree with fundamental research's position that M&A and consolidation is going to begin to heat up in the Canadian space. I think when you consider Delta 9's financial position, our financial performance, really we would shine a light on, I think, the value opportunity that exists here in Delta 9. We currently have about 100 million shares outstanding, with our current market cap sitting around 50 to 52 million. Means again that the company is trading just above 1 times trailing 12-month revenue, where again it's been suggested that our industry peers, on average, now that includes some of our larger peers, will trade at upwards of 6 times revenue. And when considering M&A, it looks like there are companies that are willing to pay even a larger premium than the industry average. We obviously feel this represents an arbitrage type opportunity for investors when they're looking at the cannabis space. There are names that are now undervalued. We would certainly put Delta 9 in that category, and again, feel that there's a strong value proposition for investors considering investments in the cannabis space when you look at Delta 9's business. Finally, on why investors should consider Delta 9, I think it can't be discounted that our businesses have been considered essential through COVID-19. This obviously mitigates the risk of financial fallout due to government closures and shutdowns. We have a real track record for success, again, year-over-year increases in top-line revenue and beginning to produce a track record for profitability. Strong investment from management. Management is currently upwards of 40% of the equity in the company. We're strong believers in supporting the stock as management and our board of directors. The company's diversified, our 3 diversified revenue streams, obviously also mitigating risk and providing further paths to growth. The company's demonstrated a path to profitability and that this business model works, an attractive entry point valuation, and the opportunity for international expansion. Again, I mentioned the US opportunity, obviously a lot of excitement around the most recent US election cycle. Every company now looking to the US and how can they see exposure to the US? Well, we already have that through our B2B segment, building out facilities. We'll continue to expand on that and really would emphasize that our business model is transplaceable into the US, really into any market, as there's this, I would say, growing wave of reform of cannabis laws and regulation around the globe. So again, huge opportunity, I think, for investors looking at the cannabis space. I think an even bigger opportunity in Delta 9 as the company continues to execute on its business plan for its shareholders. And with that, I will turn things back over to Sid to discuss some of the questions that we've been getting in from participants here today.
Yeah, no, that was great. Thank you so much, John. We can now open the call to Q&A. We have already received a number of questions, but if you still have more questions, feel free to type them in. So, John, let's go one by one. What's the store composition by province? Which provinces are you targeting in 2021?
Yeah, good question. So in terms of composition by province, we're currently operating 6 stores in our home province here in Manitoba. We have 1 store in the province of Saskatchewan and 2 stores in Alberta. In terms of expansion plans, again, broadly speaking, we are targeting 20 operating stores by the end of this calendar year, 2021, so adding 11 stores. Investors can expect 3 store openings in the province of Manitoba. We're targeting Q1 for those 3 store openings, and then additional store openings in our home province. These are organic store builds, so new stores, new leases, and those stores being developed and fixtured by Delta 9. And again, beyond the 3 more expansion in our home province into the back part of this year. In Saskatchewan and Alberta, much of the focus is more around M&A. We see particularly the Alberta market is much more saturated. It's very fragmented. Huge opportunity there to be essentially buying existing retail operations, targeting retailers who either have done things right and have very strong operations, or identifying opportunities that we feel are undervalued, where there's an opportunity for us to tweak product selection, bring the stores more under the Delta 9 brand, bring of training for staff, in terms of improving customer service and improving revenue. And we have seen through our track record for acquisitions that this is a strategy that can be successful. So much of the focus through 2021 will be on those three prairie provinces and expanding the footprint across the prairies. We are considering a franchise model in BC and Ontario, where we are limited from full ownership over retail operations. It necessitates a quasi-franchise model. Although, you know, the nearest term, I think return on invested capital for us on the retail side does come in our home province in Manitoba, and as well toward creating more critical mass in Alberta. But, you know, of course, we will consider opportunities over the long term across any provincial market that allows for our participation.
Thank you. Maybe you can talk a little bit about Ontario, which you, why is, because especially Ontario store count is expected to increase significantly in 2021. Maybe a little bit on how keen or how much are you looking in Ontario? And also maybe some clarity here, John. Maybe you can tell listeners if you're acquiring already established stores or are you building from scratch?
Yeah, so to answer the latter question first, we are doing both. We are building stores from scratch, and we are looking to acquire stores as well. So we will look at different opportunities depending on the market. Again, a market like Alberta, there's certainly merit in acquiring and additioning an existing customer base through M&A. But a market like Manitoba, there is still significant opportunity to continue to expand the overall store count, to diversify ourselves geographically within the city of Winnipeg and within the province, and acquire new customers. So there will be a balanced approach there. In terms of the Ontario marketplace, again, you know, becomes a difficult market just given, well, given a few factors. I mean, the restrictions around ownership mean that, you know, we're only able to participate in so much of the upside from a Delta 9 franchise store operating in the province of Ontario. There's also been some concerns around the very long lead time between the time you make an application to the Ontario Cannabis Retail Corporation and the time that one can expect to be licensed, just given the number of people in the queue right now. So we really are seeing an explosion in the overall store numbers in Ontario that mirrors what we saw in Alberta a few years ago. What we've learned from that experience is that taking a wait and see approach is not a bad thing. But I will comment that in terms of Ontario expansion, Delta 9 had our first 3 products listed in Ontario, I would say Q3 last year. We've seen great success in those first 3 products. I believe we now have 5 or 6 products listed within that market. And sell-through within the Ontario market has been quite strong from what we've seen. Now, we are concerned over the near term that the lockdowns that were recently brought in Ontario may impact purchases and sell-through within that market. So we're monitoring that closely. But, you know, in terms of our most active provincial markets, Manitoba and Alberta, we really have not seen any negative impact due to COVID-19 and general expansion in terms of people's consumption patterns through COVID. So I think we are fairly risk mitigated in terms of our geographic presence to weather any shutdown in Ontario. But again, look for expansion to come mostly focused around the prairie provinces for retail for this calendar year, and then considering expansion through franchise elsewhere. Okay.
Which of your sectors do you expect to have the highest growth this year? Cultivation, stores, or grow pods?
Oh, you know, good question. I think retail, you know, probably stands to be the largest top line growth for us through this year. Just the number of store openings, you know, considering that we're still seeing, I would say, a healthy pace of same store sales growth. I think there are certainly some tailwinds for the retail side of the business in terms of continuing to see growth into 2021. On the cultivation, the branded product side, the wholesale side of the business, I think there's a good amount of growth for us into this year as well. We started to see significant improvement in our wholesale business in the third quarter. Sales were up, I believe, about 100% quarter over quarter from the second to the third quarter in our wholesale business. And again, seeing significant traction in large purchasing markets like Alberta, as well as seeing obviously significant sell-through through our own stores and that overall store chain expanding. So as the retail sales increase, the sell-through of Delta 9 products through those retail stores also increases, and the two kind of expand hand in hand. Would note as well that the company does have significant capacity relative to our historical sales on the wholesale side. Investors shouldn't expect that Delta 9's revenue on the wholesale side of the business will continue to increase quarter over quarter through much of 2021. The grow pod side of the business and the B2B side in general is a little bit of a question mark. We're seeing a significant amount of opportunity in the United States on the grow pod side. A few larger projects in the Canadian market as well should provide some more stabilized revenue into the latter part of the first, the second, and then the third quarter and beyond this year. And of course, we have the opportunity around the D-pods, the decontamination pods as well. Again, this is a slow process. We're working with government. We're working with central services and procurement. Very often these conversations are having to include the healthcare unions. These are, the technology is specifically targeted around reusable PPE. And there is definitely a need from our conversations to have this type of technology, which ensures that when reusable PPE is not simply being wiped down with a hydrogen peroxide swab, but is actually, providing a standardized method of decontamination. So there's definitely a need, but none of these groups move incredibly quickly. I get asked by investors, have we not missed the opportunity in the window for COVID-19? No. My sense is that the world is changing. PPE is here to stay. Governments are looking to protect themselves against getting caught in similar situations to what many governments were through their experience in COVID and in being unprepared. So this type of technology and application, I think, has a number of commercial applications that any one sizable order could contribute significant revenue. Although I would guide investors as well that we are early stage on commercializing that technology. But overall, we would anticipate further top line improvement for the company into 2021. My real goal over the next few years is to see the company north of 100 million in top line revenue. At that point, the company will be quite relevant from a top line standpoint, and I think lends itself to to potential future share price gains as well as the company continues to execute.
Okay, next is most related to your expansion. How do you plan to fund expansion? And maybe an add-on to that is also on the balance sheet. You have about $25 million in debt, including debentures. How do you plan to repay the debentures?
Yeah, so firstly, on the expansion side, again, given the company is at or having passed that inflection point to profitability, there's an opportunity now for reinvestment of cash flows into expansion, as well. The company's most recent equity offering, obviously, improves the cash balance on the balance sheet, improves the debt to equity balance on the balance sheet, maintaining a healthy balance sheet, and gives us, I would say, significant cash reserves for expansion, for M&A, et cetera. Realistically, we've been able to dial in our build out costs for these retail stores. The return on invested capital is often coming quite quickly, given we're operating our retail segment profitably. So I'm not concerned regarding funds for expansion for 2021 for any of our stated expansion plans. In terms of repayment of the debenture, I would emphasize that the company's more recent equity offering puts us in a very strong position to be repaying that debenture. It does not come due until, I believe, June or July next calendar year, so 2022. So still a good amount of runway in terms of that debenture. Also an opportunity for us to be buying back those debentures in the market. They are publicly trading. The company has filed a normal course issuer bid. And I would say now would be a reasonably good opportunity for the company to consider allocation of capital towards an early retirement of those debentures if they are available and at an opportunistic price in the market. So certainly something that we are considering in advance of the maturity of those debentures middle of next year. But Companies certainly, well aware of the time frame around maturity of the debentures. I would add as well that we have a great working relationship with our bank. They were very pleased, and they provided us with a $22 million credit facility under conventional lending terms. That's Canadian Western Bank. Our average interest rates are in the area of 4.9% under that facility. So certainly an opportunity for us to be furthering our relationship with the bank and potential refinancing of those debentures. In terms of the rest of the debt on the balance sheet, the majority of that facility, apart from a $4 million standby facility, is term debt. So the company is, routinely paying down debt every month, interest and principal repayments as a part of that facility. So, I think the company is well positioned again currently with the health of the balance sheet as of year end to be tackling those debentures next year.
The next question is a little bit more product related. Have you explored doing private labels for other retailers? Have you had requests to move your products that way?
With other retailers, not necessarily, no. We are, looking at our product platform and our internal, call it pipeline or supply chain of products. If there are opportunities where we're seeing excess supply of certain products, that's where we're typically more active in the cannabis wholesale market, working with other producers. Investors will note that Canopy, Aurora, there's probably not one of the big 5 or 10 cannabis names that hasn't shuttered some form of capacity, in terms of their flower capacity. So all of these groups are looking to supplement now their capacity with bulk purchases in the bulk wholesale market. So there is opportunity for us to move product that way. Otherwise, I would say that we are more approaching the point where, with the scope of our product listings across Manitoba, Saskatchewan, Alberta in particular, adding on distribution through Ontario, BC, Newfoundland, the company, I would expect over 2021 does arrive at a point where we are distributing the vast majority, if not all, of the product we can produce on a recurring basis, and then be looking to acquire product from other suppliers, as we do with our manufactured products, things like our vapes and ingestible oils. Those are purchased from third parties. They increase our ability to supply the branded product wholesale market across our provincial markets. So, I think a good amount of opportunity for us, whether it's the cannabis bulk wholesale market or consumer branded wholesale, again, to continue to expand revenues this year. But white label in terms of competing retailers, not necessarily a path that we are looking to go down at this time.
Okay, John. So I have a few more questions, but I'm going to group them into one because all of them are asking about your share price performance. So basically the question is, D9 shares have not performed in line with the sector performance. Why do you think shares have been lagging? And also the multiple is significantly lower than the sector average. Maybe you can talk about that, John?
Yeah, for sure. I think it's been a rough ride for investors, across the sector with, equities in many cases trading down, 75% plus from historical highs when the industry experienced the real bubble type mania in 2018 and certain points over 2019. The real challenge that's come with the market sell-off in cannabis equities has been the state of investor sentiment towards the sector. We see this in taking meetings with brokers, with wealth management, with individual retail investors. And, it's very often these people did participate in the space. At one point, they may have, some degree of knowledge around the sector, but are probably not participating. So, as well as seeing share prices decline, we've also, seen across the industry struggles in terms of liquidity. Visibility is a challenge in terms of there are, I would say, literally hundreds of publicly traded cannabis companies, many of them operating in the Canadian space, all vying for investor interest. I think the encouraging component is that it appears that the market has bottomed. I think it appears that our share price has bottomed and has found relative strength over the past, I would say 9 months since last March, when the entire capital markets environment globally began to fall off a cliff. So, there is certainly critical support levels for the stock. Management has been supporting the stock as well. We participated in the most recent equity unit offering. We've been buying debentures in the market. We're obviously very bullish that at 50 cents a share is an attractive entry point valuation for investors looking to get in and see upside. In terms of how do we improve share price from here? And it's something we're very live to. This is not something that we don't consider to be a key factor in how we need to drive the ship moving forward. But it's a multi-pronged strategy. Continue to increase top line revenue. Again, that continued push towards upwards of 100 million in top line revenue needs to be a key focus, a main focus for management over the next few years. Getting to 100 million plus in top line revenue means that we will have reached a point, I would say, of relevancy from a capital markets perspective that now, again, institutional investors, et cetera, can start to become involved. Profitability is key in that as well. Investors don't simply want to see revenue or revenue growth. They want to see profitability. They want to see a business model that's sustainable. So that becomes a key focus as well. Building our market cap through acquisition, if necessary, will allow us again to improve on that critical mass. Once we reach a 75 to 100 million market cap, there are several industry ETFs which will begin to cover the stock again and start to include that in their basket of equities. That improves trading volume and liquidity, and again provides for further upside as we start to see those types of institutional buyers becoming involved. So I think there are a number of things that the company can do. Increasing visibility obviously is key as well, and we will continue to do that through outreach, attempting to attract additional analyst coverage. And again, thank you to Fundamental for bringing us on as a covered company and top pick here for the cannabis.
Okay, John.
Oh, sorry, go ahead.
Oh, no, so you were cutting off a little bit. But yeah, so listeners, we published an update on D9 last month, which has a detailed valuation and fair value estimate. So you can see how we arrived at our projections and our valuation. So I recommend you to check out our portal, research@farc.com, and then you could access all our reports on D9. So I don't see any more questions, John. Maybe you can, any final thoughts, and maybe you can also provide some guidance on when you expect your year-end results to be published.
Yeah, absolutely. So companies should have preliminary revenue guidance and preliminary results to the market around the end of January. We target from there a mid-March release for the year-end audited financials. The definitive release date for the financials will be included in the guidance that goes out later this month. So investors can expect, again, key guidance to go out around the end of January. In terms of catalysts, looking forward, investors, again, expect updates around product development and the company's progress in expanding its product portfolio to include additional derivative products. For this year, retail store openings, again, we will certainly keep the market updated around retail store openings. We would consider that our company's financials should act as, I would say, more material catalysts towards continuing to demonstrate that the company is improving from a fundamental standpoint. But I think we'll leave it at that for today, folks. And a final thank you to everyone who joined and asked questions. And thank you again to Fundamental Research for giving us the platform for the discussion today.
Thank you, John, and thank you everyone for taking time today. A recording of this will be uploaded on our channel shortly. And if you wish to see our reports on D9 and all the other companies we cover, and also our top picks, please visit our website at research@farc.com. Thanks again, and wish you all the best and stay safe.